and gentlemen, welcome back to the channel. Markets are having a huge day, hitting a new all-time high today. The S&P at the time of recording this video is about $590 per share for the SPY following the Donald Trump win. There is all around good news today. No matter what political spectrum you are on or who you voted for, at this point, it doesn't matter, okay? In terms of financially speaking, right? You have to make the best with what we have. If you're unhappy politically, well, that shouldn't affect your money. So we're here to talk about money in this video. Congratulations, Trump. I did vote for Trump. I'll just put that out there, even though it doesn't matter. It's hopefully a good day for America over the next, 4 years. Hopefully this brings more prosperity. Now, markets, generally speaking, are happy about this, okay? The S&P is up over 2%. The Dow is soaring. The Dow is the biggest winner on the day today, and that was as to be expected, okay? The Dow up 3%. In fact, the Russell 2000 is up 6%, so the Russell's having a better day than the Dow. That's really as to be expected. I talked about this in videos leading up to the election, that if we did get a market rally following the election, which did seem most likely, I talked about that in yesterday's videos, it was going to be mostly in the Dow and the Russell. Interest rate sensitive areas, as well as economically sensitive areas, really economically sensitive areas, because what the market is saying right now is the economy is going to be better under a Trump presidency. That's why 10-year Treasury yields are up 15 basis points at the time of recording this video. That's a big move higher in yields, but it's just saying the economy is going to be better, that you're not going to need as many rate cuts. Whether or not we get that really depends about inflation. And that's why with the Fed on Thursday, that will also be an important catalyst for markets. What the Fed thinks about inflation, if inflation's going to, keep coming down, or if we're going to have a spike in inflation, the Fed's going to give us a little bit more clarity on at least their view of inflation later on. Now, what's actually fascinating about today is the VIX is down over 20% today. There is a big unwinding of hedges, of short positions, of puts on markets today, which is incredible, right? Because wow, there was a lot of uncertainty heading into this election, and the VIX, that's why the VIX was at the 20s, anywhere from 20 to 23 over the past week or so. And now following these election results, the VIX is down 23%. So not 20%, 23%, down to 15.75, which is a more normal level for the VIX. Now, what this is going to do to the markets is really allow Wall Street to unwind those hedges, okay? Unwind those short positions. This is going to lead to likely a multi-day short squeeze for the broader markets. And if you can't tell, I think this puts markets out of the immediate danger zone, okay? So markets bounce at this 50-day moving average, and now you're back up to a new all-time high. You're above your 20-day moving average. So in the short term, that is very good momentum. We tend to kind of ride the 20-day moving average higher until we break down, right? You find a lot of support here at this white line during uptrends. And when you do go through downtrends, that's when you tend to get these corrections, right? So we were kind of in a danger zone here over the last couple of days, bouncing or sitting right at that 50-day moving average. Now that you're back above that 20-day moving average, you can likely regain an uptrend. And it does look like, at least for now, whatever 3% or correction or so that we were experiencing is likely over. Now, again, there's going to be other catalysts. There's going to be the Fed. There's going to be other data points going on. And we still have a couple of undecided elections in the House and the Senate. So we don't really know to what degree the red sweep is going to be. But it does look like we did get a red sweep. Markets generally don't like sweeps, but markets really don't like uncertainty. And a lot of that uncertainty is being taken away now at this point. Now, the CNN Fear and Greed Index is going to pop into greed territory, so that's definitely going to look good there. Now, Dan Niles writes on X, from the day before the 2016 election through year end, the last time President Trump won, the S&P was up 5%, led by the Russell 2000 up 14%. Financials up 17%, 8% for industrials, 9% for energy. Infotech lagged up 2% versus 10% year to date up until Trump won the White House versus the S&P up 4%. This reinforces my belief that the market will continue to broaden through year end. And that's what I talked about heading into this election. If we did see a Trump presidency, you can expect a broader market rally, which there's a lot of room here for markets to broaden way out. Okay, if you even look at the percent of stocks trading above their 50-day moving average, yes, this is up 7.4% today. So 7.4% of all stocks are now breaking above their 50-day moving average versus yesterday. But you're still only at 56.6%. Like, this is still not a super strong number. You're not even close to levels that you would consider euphoric. Isabel Net on X writes, the S&P 500 historically, when it's up more than 17.5% year to date going into November, the final 2 months of the year have never seen a decline with an average gain of 6%. So you're higher in November 85.7% of the time, and you're higher in December 78.6% of the time. Again, with a average and median gain through the end of the year, up 6% for both of them. This is a good stat that is in the Bulls' favor. This is actually the Russell 2000's fourth largest gap up in history. If you exclude the Rona recovery, some of those really strong days after the initial drop in 2020, this would be the biggest gap up in history. So for all of you small cap investors, all of you, high risk, high reward investors, we are basically kin. That's me to a certain extent. You got to pick out some small caps and you got to own them, the best of the breed. And it's a good day for those companies. And it's likely going to be a good rest of the year for those companies, judging off the 6% rise in the Russell 2000. And Mark Lehman on X gives a U.S. election cheat sheet. He actually did this 2 days ago. For an equity reaction with a red sweep, it is a risk-on market led by shorts covering. You want a long Republican policy winners versus short underperformers. Trade policy, short EU exporters to US or short US importers from China. Healthcare, short hospitals, Medicaid exchanges. Financials, go long investment banks. And commodity equities, go long commodity equities. So that's exactly what you are seeing right now, is a short squeeze of the shorts that have been put on in anticipation of election volatility. The uncertainty, a lot of it has to do with, we just thought it was going to take days to find out who the president is. That in and of itself is seen as great news. Kathy Jones on X writes that 10-year Treasury yields are soaring on inflation/deficit concerns. I would argue 10-year Treasury yields are soaring on hopes that the economy is going to be better than expected. Yes, there is some of this inflation/deficit concerns that are also a part of this, but really 10-year Treasury yields revolve mostly around the economy, because let's be fair here. Inflation only occurs during a strong economy 99% of the time, minus any weird blips in the data we've seen over the past 100 years. If we're expecting higher inflation, that means we're expecting higher economic growth. So really, it's just a sign that markets are expecting higher economic growth. Seth Golden says, fact, there are portfolios with hedges that are so deeply underwater this morning, they are no longer hedges, but weapons of portfolio destruction. I'm sure you were told that risk management was rule number one, but are unfortunately discovering today that knowing how to take risk is rule number one. Always remember the proper and logical sequencing for every investment/trade. Know how to take risk, then how to manage said risk. Renaissance Macro Research says last night, Stephanie Rule, noted that the negative reaction in the bond market was discounting increased deficits and inflation, but the markets are treating this as a re-rating of real growth. Surging dollar, financials, falling oil, and precious metals hardly portends disaster. And give it up for Renaissance. I mean, that's what I just said before I even seen this post. We're in agreement, okay? This is not the deficit and inflation argument that's affecting 10-year Treasury yields. It is the argument that the economy is going to be stronger. Yes, there can be inflation, impacts to that. Higher inflation is a possibility, but this is really just an expectation of higher growth. And worth mentioning, oil is down about 3% today, so expect to get some relief at the pump in the coming days, especially if oil does continue to sell off. You also have gold down 3% and silver down 5%. This was, after all, I guess the Democratic trade, gold and oil, is not the Trump trade. And seeing a move down in gold, silver, copper's down 5%, platinum down 3%, palladium down 4.5%. This is good news for capital allocators. Elon Musk writes on X, the people of America gave Donald Trump a crystal clear mandate for change tonight. And Trump already is saying that we're going to be paying down debt and reducing taxes. And at the time of Donald Trump becoming the 47th president-elect of America, Zero Hedge wrote on X, at this rate, the yen is collapsing. The BOJ will have to intervene tonight. So pressure on global currencies. It's also being reported that Russian President Putin confirms his readiness to begin negotiations with U.S. President-elect Donald Trump. And you could bet your ass that North Korea, Russia, all these hostile actors probably picked up the phone right away to congratulate Trump, to try to get on the right side of things. And this is pretty wild. Trump won Starr County, Texas, the most Hispanic county in America, at 97% by 16 points per Ryan James Gerdusky. The last time it voted Republican was 1892. Elon Musk fully endorsing Trump will end up being the biggest high-risk, high-reward move he's ever done for Tesla, and it looks like it has paid off. If we take a look at the S&P, the SPY ETF, short interest has risen a lot in recent months, from about 9.36% up to 10.16%. That's a big rise. In fact, from late August 19th or so, short interest was at 8.94%. Today, at 10.16%. There's a lot of shorts that are on the wrong side of this market rally. And I think you're looking at a multi-day short squeeze in equities that is going to start and last a while. Now, specifically for Tesla stock, Tesla is up 12% at the time of recording this video at $282 per share. And I think all of what I've said in this video could not be more applicable to specifically Tesla. You are going to see a large short squeeze in Tesla as favorable policies will likely start to emerge for Tesla. And there's been a lot of shorting activity in Tesla, and that's really it. There's shorts covering on short positions, driving the stock up 12%, and you're likely to lead into a rally well into the 300s over the coming days. Now, let's take a brief look at what the short position currently looks like for Tesla, just to give you a sense of how much fuel there is on this potential rally. And we can see short positions in Tesla sitting at 2.84%. The dollar amount sold short in Tesla at 19.92%, with 79.21 million shares that are currently sold short. It's a lot of shares that need to be bought back. And option activity for the day today is going to be well in excess of $1 billion with a positive order value over 80%. So let me know what you think about this information down below in the comment section. Have a great rest of your day, and I will see you in the next one.